Okay, we're going to solve some problems here. This is chapter 7, Kimmel. The chapter is fraud, internal control, and cash. And we're first going to look at 3 exercises. Exercise 4, exercise 8, and I believe it's exercise 19. So let's read exercise 7.4. So this is exercise 7.4, dealing with internal control issues. So what they're asking here is listed below are 5 procedures followed by Gilmore Company. And there's 5 items here. The instructions are asking you to do the following. Indicate whether each procedure is an example of good internal control or weak internal control. If it is an example of good internal control, indicate which internal control principle is being followed. If it is an example of weak internal control, indicate which internal control principle is violated. And they have a chart there to fill out, but we don't really need to do that. So let's read each one of these. Employees are required to take vacations. Well, this is an example of good internal control, and it deals with the human resource controls. And specifically, you want employees to take vacations so that other employees can fill in for those roles and identify if there are any issues, fraud being committed. So requiring employees to take vacations is an example of good internal control. Second item, any member of the sales department can approve credit sales. Well, this is a weak internal control, and it's establishment of responsibility. So we talked about responsibility. One employee should be responsible for a function. So if something goes wrong, management, the stockholders, the owners know where to go and who created the problem. Item 3, Paul Jacquard ships goods to customers, bills customers, and receives payment from customers. Well, this is a weak internal control because it violates the segregation of duties. Duties should be separated so no one person has complete control. Now, if an owner of the business has that control, it's not a problem. It's his business. Number 4, total cash receipts are compared to bank deposits daily by someone who has no other cash responsibilities. So this is a good example of a good internal control. Independent internal verification is what's important here. Segregation of duties is important, but also independent verification is even more important. And number 5, time clocks are used for recording time worked by employees. This is an example of good internal control. It's the concept here is physical controls, and you have that employee using a time clock as opposed to somebody writing that time in. So that was exercise 7-4. What I want to look at now is exercise 7-8. And 7-8 is the bank statement. And reconciling the checking account, the bank account, is a very important internal control. So this is, and we'll put it over here, exercise 7.8, and this is the bank reconciliation. And remember what we're doing here. We are reconciling both the bank and the book side. So we're going to have the bank side over here, and we're going to have the book over here. We're both coming down to what? The correct bank balance. So let's read the problem here. It's a very easy one. Following information pertains to Ranchero Company, and they give you 5 items here. Cash balance per books, that's the general ledger balance, $73.64. Cash balance per the bank, that's the bank statement, $73.28. Outstanding checks, $686. August bank service charge not recorded by the company, depositor, $38. Deposits in transit, $2,700. In addition, $2,016 was collected by Ranchero Company in August by the bank through electronic funds transfer. The collection has not been recorded by the company. prepare the bank statement reconciliation. So let's take a look at this. And on the bank side, we're going to have balance per bank from the bank statement. And they said that balance is $73.28. And then we're always going to add deposits in transit, DIT, deposits in transit. And they said that number was $2,700. And we are going to subtract outstanding checks. And they said that amount was $686. Going to subtract that. And we have a balance. Let's call it the correct balance. And that works out to be $93.42. Now that balance should also agree with this one over here when we're done with the book side of it. So the balance per book, that's the T account for cash. That's the cash account on the books. They said that balance was $73.64. And they said there was a collection, right? They specifically said, in addition, 2016 was collected for Rontrell Corp Company by the bank, but they hadn't recorded that yet. So we're going to add note collection. And they said it was 2016. And then lastly, they told us that there was a bank service charge. We're going to subtract that. BSC, bank service charge, $38. We're going to subtract that. And the balance here is $93.42. These two numbers must agree. That's the correct balance. Now, everything on the book side, all the adjustments on the book side are going to require general journal entries, because this is the balance on the general ledger, and we need to get it to this balance here. So we need to have some journal entries, not adjusting journal entries, regular journal entries. So the first one, these are all up at 8/31. We need to record that collection of accounts receivable. I'm going to have a debit for 2016 and a credit to accounts receivable 2016. So an increase in cash with that journal entry. And then secondly, we need to record the bank service charge, BSC, bank service charge, which is an expense for $38 and a credit to cash for $38. So that's a very straightforward bank reconciliation. We'll look at a more difficult one a little bit later in another video, but that's a simple one. And the last exercise I want to do for this video is exercise 7-19. And this is a petty cash problem. Petty cash. And we remember what a petty cash fund is. That's the little bit of cash that's maintained in a drawer, a secure file cabinet maybe, where the company uses it to record small expenditures of cash during the period. So this is exercise 7-19. Kale Company maintains a petty cash fund for small expenditures. These transactions occurred during August. So on August 1, they established a petty cash fund by writing a check payable to the petty cash custodian for $200. So here we're going to debit the account called petty cash for $200, and it comes out of the main cash account for $200. On August 15th, replenish the petty cash fund by writing a check for $175. On this date, the fund consisted $25 in cash, and these petty cash receipts: freight, entertainment, postage, and miscellaneous expense. Remember, the petty cash drawer, the combination of currency, cash, and all the receipts should always add up to, in this example, $200, the amount the fund was established for. So in 815, they need to replenish that account. So they're going to have various expenses, freight out. These are per the receipts, $74.40. Entertainment. Entertainment expense, $36. Postage expense, these are all expenses, $33.70. Miscellaneous expense, something that can't be classified, $27.50. And because it doesn't add up, because these items here do not add up to $175, they are cash over or short for $3.40. Credit to cash for $175. So these items here must equal the $175. They don't have receipts for this last item because it's change and they lost track of it. So cash over or short. Let's look at the next item here. They increased the amount of the petty cash fund to $400 by writing a check for $200. So this is the entry that occurs on 8/16. They're increasing the fund, so they have a debit to petty cash for another $200 and a credit to the main cash account for $200. Again, increasing the account. And then lastly, on 8/31, they want to replenish that account again by writing a check for $283. So they have a debit to the postage expense. Again, these are the receipts that they have in file for $145. They have another piece for entertainment for $90.60. Have freight out, which is an expense for $46.40. And again, it doesn't add up completely. So this is cash over or short. In this case, $1 and a credit to cash for the $283. Again, remember, the combination of receipts and currency should always equal the amount of the petty cash fund. Lastly, they ask a question here. Post to the petty cash account. So they're asking you a very simple journal entry here. And they have an account called petty cash. Debits and credits. Here's the establishment of the fund initially at $200. Here's the increase in the fund for another $200. The balance of the fund is $400. That account's never going to change unless they add to it or decrease from it. Now there are some questions with regard to internal controls here. And it says here quickly, what internal control features exist in a petty cash fund? So number one, a custodian is responsible for the fund, right? Establish responsibility, one person. So if there's a problem, we know who to go to. Number two, a pre-numbered petty cash receipt signed by the custodian in the individual receiving payment is required for each payment from the fund. Pre-numbered forms, we can account for all of them, plus we have signatures to establish responsibility. Number three, the treasurer's office examines all payments and stamps supporting documents to indicate they were paid when the fund is replenished. So they need to have documentary evidence for the actual expenditures, ideally a receipt and signature for those expenses. The cash over or short is a very small item and they want to keep it that way unless it gets out of control, and then we need to ask some questions. And then lastly, surprise counts can be made at any time to determine whether the fund is intact. So someone's going to come in and verify it at any given point in time. So those are the three exercises that I wanted to take a look at. Thank you.